Hello, everyone. Welcome to Red Summer Holdings, a real estate partnership comprising of 8 owners: Tochi, myself, Zoe, Ramad, Charles, Ikechi, Chima, Innocent, and Ike. Here we discuss the evolution of our business, which shows you how group economics can be successful in regards to real estate. If you believe there is value in this information, please like, comment, share, and subscribe. With that being said, let's get to the content you've all been waiting for.
So I was looking at what was I looking at? I was looking at or listening to our meetings from before, and how we said it is that we would do a purchase with cash, and then once we have the purchase with cash, we would apply for a business loan uh, secured by the value of the property to not a business loan, sorry, a business line of credit secured by the value of the property, and then from whatever that was, we can add it as cash for the next time we want to purchase. So like some time would lapse, we would still be doing our monthly payments. We would, after a short time, start to get cash flow from the new property purchase. So all these things are helping to purchase the next one. And then when we get to that point, we'll have a business line of credit for however much that we can use as leverage also in a cash deal for the next one, or use it as cash for the next deal, whether we want to do that, whether we want to do a cash purchase or not. I think we probably would. It would be consistent, and it's easier to come up with cash when we want to do something. All those things being said, though, there's several options in between the purchase of the first property and the second one. In that once we have that line of credit, we have the income coming in from the property, and we have our dues. We have that pot of money, and we're ready for it. But we once we draw on the line of credit to purchase the next one, now we have a new debt. We have basically like not a reverse mortgage, but a mortgage. We have leverage now on the first property that we have to pay down. And so what would be the next step? Do we want to refinance the first property to get cash out, and then now that one has a note on it that we owe? Or do we want to continue to use that one would have a note on it that we owe, but we would use the cash out to pay down that line of credit, and then you can request more credit? Or is that basically how that goes?
Wait, so you're saying, just so I can follow the timeline, we buy a property cash, have a line of credit on it, and then use that line of credit for what?
So we buy property cash. We get we buy property cash. Once we have the property cash, we start the process for applying for a business line of credits backed by the property, the income from the property, basically. In the meantime, we are cash flowing the property. We're still getting our dues. And now we have whatever this line of credit is that we can use as cash for the next purchase. So when we get to the point where we want to purchase the next property, we can use the dues, the line of credit, and the cash flow as the pot for essentially the down payment or the purchase of the next property, however we want to do it. At that point, though, now we have leverage on the first property, right? And so
no, you don't have leverage on the first property.
Well, we don't have leverage on the first property, but we owe money. We are using credit, basically. I shouldn't say leverage on the first property. We're using credit.
Yes. Yeah,
Yes.
we have to pay monthly. It's not the whole thing. We can take our
You're
time.
cutting out,
We can do
Charles.
it all at once. However, but yes, there is shit. Can you hear me?
Kind of, but
No.
it's not,
Hold on a
not
second.
reliable.
Hold on 1 second.
Charles is definitely in the back cave, for sure.
All right, can you hear? Is this better?
Yeah, it's better.
All right. So what it is you have a business line of credit with a balance that you have a minimum monthly payment of, right? That minimum monthly payment is usually, so the way business lines of credit work is usually it'll be interest only for some period, and they're going to do a periodic review maybe once a year, once every 3 years, depending on what the terms are, and they want to see it get down to zero at least once. They want to know that like you're not just like using max leverage all the time and always teeter. They want to see you use it and then pay it off, use it and then pay it off. But you don't have to pay the whole thing off in a month or 6 months or 10 months, whatever. They just want to see you, they want to see that balance going up and down. So the way that I would look at it is, I think we would buy the first property cash for 70, get a line of credit, a business line of credit. Now we have 50 to play with. Maybe it takes us a month or two or whatever, but whenever we're ready, right, go buy the second one, also with cash, right? So now we have 2 properties that we owe free and clear, and we have a line of credit with a balance of 50,000 that we need to pay down, right? The monthly payment on that is whatever it is, but the cash flow from the 2 properties now should help us offset that, right? At that point in time, we have a couple options, right? At that point in time, we would probably, in my opinion, either go to a different bank and have a completely separate business line of credit that's secured by this completely separate, different property. So now you have 2 different business lines of credit, right? One with a 0 balance, one with a $50,000 balance. You could take out a line of credit on the first one and then pay down the second one completely. Now that bank is like, oh, okay, cool. You guys, you used our credit and you paid it back off. Cool, we trust you. And you can just keep ping ponging back and forth. And then on the third property, you add it with bank A, right? And then you use that money, you go buy your 4th property, put it with bank B. So you're basically playing 2 lines of credit against each other. And on paper, right, it looks like you've paid off your debts completely on either side. Oh, okay, cool. But in reality, you're always keeping like half, right? You always have some amount of your line of credit that you're using in total. But with each specific bank, if they're looking at their record of your history with them, like, oh yeah, Summer pays their stuff down. Cool. And again, as you do that, they might give you they might give you a higher credit line without even needing to add more property. We always could add more property to boost it on our own, but it's been my experience that if you have a good relationship with your creditors, they'll be willing to extend you credit, because you can get an unsecured business line of credit as well. That's obviously just a little bit harder, but like it's all relationship based. If they see you and know you and trust you, then okay, cool. It's always, if you're a stranger off the street, they're going to ask you for some proof, or they're going to ask you for some collateral and all that stuff. But once they know you and trust you, that relationship opens up a lot of doors. So that in my opinion is how it plays out, right?
That's that clarifies a lot for me, because before what I thought it was is that we have one source of like credit, and then we use it, pay it down, ask for extension, use that, pay it down, ask for more, use that, but what you're saying is like ping pong, like you said, back and forth between the 2.
Yeah.
That makes that's also interesting, because then
you got to put that on the paid portion as well, like that. Yeah, that's 5 minutes.
Paywall. Something IK said earlier was the paywall stuff too. Oh, the thing IK said about leveraging your stocks for credit, that's some paywall.
That's hell.
We're charging. That was a gem. In my mind, I thought gem emoji when they were talking. So definitely that one is. But for this one, so does that mean, so like let's extend it a little further. If we're doing ping pong, right? Then
we're calling it now ping pong.
Yeah.
Okay.
Yes, it is.
Yeah.
It is what we're calling it.
That's our version of Burr, I guess.
It's ping pong finance.
It's
some shit we just invented.
Sure, like that.
So then the scheme could be that we ping pong. We get the business line of credit, from maybe somewhere where it's easier. So like a private lender, where there's less paperwork, yada yada yada. So would it be better to do that and then ping that, pong that ping with like a credit union? Then we can get credit unions back in the game. Do credit unions do secure line of credit? They do, yes.
Yeah, they do. I mean, that's where I got the quote from. I dropped the quote in the group chat. So I talked to my credit union, and they're like, yeah, these are the terms. It's super straightforward. Because 70% LTV.
Well, no, I'm talking about business line of credit.
It's a business line of credit backed by real estate. So
backed by real estate. Oh, they still okay, yes. So yeah. Yeah, so it's like, because this person, I have a relationship with this bank, and they do a lot of my like they have my business checking account, and they've done some cars for me. So like, this person knows my business really well, and like I can always just
say, hey, this is my idea, will this work? And she'd be like, nah, that's come on, man. Or she'd be like, yeah, that can work. So with this thing we talked about, ping pong, right? She laid it out with their bank, right? The way that they do it, it's 70% LTV. It's an interest rate. It's whatever the prime rate is plus like 3%. And then it's a 3-year term, meaning technically you have the line for 3 years, but if you want an extension and as long as you have good history, they'll keep it going. So a 3-year term doesn't mean you have to pay it all back by the end of 3 years. It just means that they want to see activity. And then they'll basically reevaluate you. Like if they don't like the way you're using it, they can call the whole thing due at the end of the 3 years. But like as long as you're going up and down and using it and paying it down and using it and paying it down, then you're totally fine. The minimum payment is interest only, which I thought was amazing, right? So like in terms of for tax reasons, that's amazing because you can get money and interest interest payments for a business are tax deductible anyways. So like I was like reading the term sheet and I was like, okay, what am I missing here? This is a no fucking brainer. You know what I mean?
Yeah, this is
so like even the money that
also,
we're paying, like the cost of the money is tax deductible. So it really is like free, as long as you have an asset to back it up.
Yeah, as long as the money is performing. So as long as the deals are good, then it's free. Which is like all you can ask. That's pretty fair. Well, that pretty much cleared it up for me. I don't really have any more questions. Do you guys have any more questions?
Real quick, so business line of credit is, yes, it's a credit card. And so let's say you have whatever, you get it, you pay it off. And like a credit card, you can either keep your credit card or cancel your credit card. Is that what you're trying to say?
No, it's more like it's the bank will cancel it after, like it's like if your credit card had like an expiration date, it would say, hey man, like here's your Discover card, but just so you know, in 3 years, we have the option to cancel the card in 3 years. Now, if you use it responsibly, we won't. But like if we don't like the way you're using it, we could basically say, hey, look, 3 years are done. We're not gonna, we're gonna close this credit card. Yeah, exactly.
A credit card can be frozen where like you owe on it, so you got to make your payments on it, but you can no longer use it as money for anything.
Draw against it, exactly.
Yeah,
exactly.
And it could be that's a flexible term, so you can have there's gonna be a 3-year freeze or a 3-year option, basically to extend. But so
are there costs associated with A, establishing the line of credit, and B, extending it?
So to establish it, I do think they would require like an appraisal to make sure that, okay, you say this thing's worth 100,000, but we need to verify that ourselves. So yes, there are some costs with it, but it would be, it's not exorbitant. Like there wasn't anything that surprised me when she walked into it.
And what if you already done an appraisal like within the same year? You think that they can just take that appraisal so you don't have to redo it?
I doubt it.
Some will.
Yeah.
For the extension is the extension of credit based on the increase in value of the asset, or is it based on the good credit relationship where you're doing what you said you would do over that 3-year span and paying it back?
It's a little bit of both, right? Like, if you want to raise the line of credit, you can absolutely add more collateral, right? Like that's I could force the line of credit to go up by bringing more property to the table. And you could probably get it to go up faster. I don't think they're going to double it based on your good history. I think they're going to want to see like better, more performance stuff. But like, truthfully, I haven't been in that situation. Like this is all like theoretical, what we're talking about. Putting myself in the shoes of an underwriter, I would think that we could get some, increase based on our history, but I think the majority of it, at least at first, the way we get it up faster is going to be with just more property to start. Maybe 2-3 years down the line, once it's like, these guys have ran through 500,000 and they haven't missed a payment. Yeah, at that point, maybe they will trust you with more because, the difference between 20,000 and 40,000 is huge. The difference between 500,000 and 600,000 isn't that big in a weird way, right? Like, so that's kind of how I would see it playing.
And it would make sense. And I mean, I agree with you with the either or, because, you know, a function of drawing the credit would be to get more assets. Like that is the reason why
exactly.
we would.
Exactly.
Or to increase the value of the asset we do have, you know, some sort of capex or whatever is necessary. Like it would all go to increasing the value of what we're holding. So it's like
That's right.
a win-win. Okay.
Yeah. Like the most important thing is like by having two or multiple sources is that you'll always have a history of paying the balance down completely. So like they'll always be able to see, oh yeah, like we gave these guys 50,000 and they paid it down to zero multiple times over these 3 years. We can absolutely trust them. You know, like that's the benefit. And you know, they don't need to know that like our source is just another loan. You know what I mean? So both people are satisfied that like we've been able to honor our agreement.
Fair enough. I need to listen to this back and then draw it out like on a dry erase board and stare at it. But so far I haven't seen any issues in my brain. Okay, that's definitely paywall. We may not release this meeting. This one is too much.
I mean, this could be on the you know, the greatest hits album, like the Lost Studio session.
The Lost tapes.
Filmatic.
Okay, I think that we're good.
Lost Tapes 1, not Lost Tapes 2
for now. In the meantime, like we'll have 2 weeks before we, you know, meet again. And so if something comes up, we can just follow up with that then.
Thank you for watching. Please remember to like, comment, share, and subscribe. Peace.